Thanks for tuning in to Talking Point. I'm your host, Niraj Shah. We've been hearing about a clamor for reforms ever since any government comes and takes power, and it was no different with this one as well, all through the first term or the second term. But it's very rare that I read a note from people who look at markets and economy very closely and say that, hey, the reforms are now done. The bucket list or the bucket for the government to do additional big ticket reforms is practically empty. And now we have to wait for the impact that these reforms would have on multiple things, including growth and inflation. Our guest, Aditya Narain, in a note written on October 12th, has kind of argued for this point. Let's get him in on this conversation on Talking Point today to talk about his thought on that. Plus, what does all of this mean for asset prices and equity markets? Aditya, so good having you. Thanks much for joining in. Hope all is safe.
All good, all good. Thanks for having me over.
No, the pleasure is ours. We had a lovely conversation the last time on multiple things, including in that large strategy note that you guys wrote about information technology, as I remember, and it turned out very well. So would love to talk about all of that and more. But first, Aditya, just a very quick basic question on how are you reading the market sentiment right now, considering we're a few days away from the big US elections, and the conversation now seems to be suggesting, or the bites seem to be suggesting, that maybe a stimulus is pushed down to after elections. Does it have the potential to create near-term upheaval causing volatility?
So I don't know if it has the potential to cause an upheaval. We've hardly had upheavals once, the initial dust has settled or something has been, anticipated as much as it has been in recent times. So I don't know if there is the risk of an upheaval, but I think the fact that there's been a lot of bullishness, a lot of the data has been very good, and that some of it is now tending to peter out, whether it is the extent of the stimulus, whether it is some of the end demand data, or whether it is the reality that fiscal deficits are out of hand, just as valuations seem to be much higher than they've typically tended to be. So I think you're going to end up having a situation where there will be some slight risks to the market in terms of one-offs and event-based. But I think the fact that the market could drift down over the rest of the year, I think, is a reasonable possibility.
Other part of my question, Aditya, and you would probably be a very good person to answer this. At least to my understanding, when the virus was front and center in the US and Europe, it hit flows very hard back in March and April, right? Now, it seems that a wave 2 is front and center in Europe, at least, and in US, 2 cases are spiraling. What are your large clients telling you about flows into India? Because while they've looked okay, are large clients of Edelweiss kind of stepping back for putting in more money?
So I think one of the things that does tend to happen is that flows tend to chase a little bit of performance, right? So I think one of the reasons why you had accelerated flows was not just the fact that there was more money in the system, but that India had started doing well, right? So I think that is one thing that one must keep in mind, that flows tend to be followers after the initial moves have been made. So I think that's one bit. I think the second bit that is important is that even if there is a staggering or a fall off in terms of economic activity, the reality is that the need to keep these economies up is high. So while there can be disappointments in terms of new inflows or new stimulus not happening, the risk that it is pulled off, I think that is very, very modest at this point in time. And if anything, whichever US government comes in, either the current package will go through or a more aggressive one will come through in the event that it is the Democrats. So I think in that context, I think the risk of flows being pulled out sharply, I think those are very minimal. I think the risks that people have extrapolated sustained flows, that might play through a little bit. And as I said, I think you could see some tapering off that happens in terms of markets over the rest of this year. I think what you need to keep in mind is that I think the big delta is not necessarily so much in terms of flows, but it is in more likelihood, it is in terms of economic data points that come through, either which disappoint, which I think there is a reasonable risk of, right? Or if in the event that they actually tend to surprise. So I think the money is there in the system. It will not necessarily move very materially in absolute terms. But I think how demand plays out in economies, I think that is what could be more sensitive than has been the case so far.
Okay, just one more one more plug as well, and then and a question to that, and then of course we'll get to the note, Aditya. So the editorial team at BloombergQuint has just started off a small live blog wherein we're talking about our assessment of what the results say about the economy, and all of us have our own interpretations about what the quarterly results purely and the commentary is telling us about the economic factors. What is your analysis out there? What is your reading about whether, I mean, IT is separate, but the economy
Yeah.
linked sectors and their performances, do they give you any indications about what could happen to the economy going ahead?
So I think a couple of things. One, that clearly things are nowhere as close to as bad as people thought they would be at one point in time, right? So I think that clearly establishes itself. I think the other is that there has been a progressive improvement. August has been better than July, September has been better than August, and by all accounts, October has started off being better than September, right? I think the third thing is that a lot of the data that you're seeing, right? Not all of it, but a lot of it is at the end of the day, production side data. What is being filled into inventory pipelines, what is being pushed out into dealerships, right? And basis that, you've had management commentaries also, which have tended to be more positive than you would have tended to expect, right? But it does not fully necessarily correlate with end demand, right? And that's in part because you have a festive season where people will in the normal course fill up inventory pipelines. So I think the reality is, while stuff has looked better, it is no doubt well ahead of our expectations, right? And managements are talking more positively. The reality is that the dust will settle over the next couple of months, where you see how much has been manufactured and how much has effectively been bought, right? If those two match, you're on pretty comfortable territory. The risk is that those might not effectively match, right? And I think the fourth point from a real economy perspective is that clearly the sense that you're getting is that it is continuing to get to be a narrower and narrower economy, right? That there is market share gain that is substantial for the biggest boys or the best boys, right? And so it can be misleading to suggest that the entire economy is working as well or rebounding as quickly as some of the biggest and best companies are doing, right? And I think so there are two elements to it. Do you get stocks to play because they're doing very well? Potentially, yes. Is the economy in its breadth expanding in the same manner? Possibly no, right? So I think these are the key elements that the results tell you so far, but otherwise, generally, the numbers have been good. I think the reality also is that, you've had a lot of good numbers that have come in and stocks have sold into them, right? And to some extent, that is suggesting that, one, of course, prices have been potentially a little elevated. Potentially, the stock response has been much stronger than necessarily what the underlying is. So I think there's a leveling off that is happening at this point in time. But I think at aggregate, it's clearly better than what one would have expected. Corporate risk appetite and sentiment has distinctly improved vis-a-vis where it could have been. And now the proof lies in the eating, and you just got to see how much people eat, buy, consume over this festive season.
Yeah, well, maybe two-wheelers is a sore point, but cars seem to be okay. I was talking to a cell phone dealer yesterday, and they seem to be suggesting that price points are okay and demand is great. But anyways, let's get to that very interesting note, Aditya, that you guys have written. And viewers, the title of that note is Reforms. It's a strategy note, of course. October 12th is the date, so 15 days ago. But it says reforms done, reflation due. Aditya, what's the genesis of this note? And then I would want to talk about some very interesting charts that you've kind of given as examples to corroborate your case.
Yeah. So I think the idea really was to, and I've been covering the markets for a long time, and as analysts, as strategists, we've always had these bucket lists. Reform is a word that has been bandied around very generally, for decades, literally, right? But I think if you really look at what's happened, I think two things have happened. One is the amount of reform, all the tick boxes that people wanted knocked off, right? I think you've actually had a lot that has happened over the last 3-4 years. So whether it is RERA, whether it is GST, whether it is more opening up on FDI, whether it is the IBC and most recently the farm laws and labor laws. If you step back and really see everything that the market and policymakers have asked for decades has actually now fundamentally been done. There are only two that are really left, which you could call of any significance. One is land reform, and I think that's more challenging given the duality of the state and the center involved. And the other is privatization, which quite honestly, given where values are, given the way the economy has evolved, I don't know if there's such a big play there in any case. So the bottom line is basically a lot has been done. But the flip side is that I think, a lot of people in the market, including people like me and commentators, you also tended to believe that reforms were a kind of a magic wand, right? And that the response that you would get from the economy would be fairly quick, fairly broad-based, and fairly growth stimulating. But if you step back and see, I think every major reform that has happened, right, whether it is the IBC, whether it is GST, whether it is RERA, the economic response in that space itself so far, and that could be 3 years long, that could be a year long, that could be 6 months long. In each of these cases, there has been a drop-off in what was the intended result, right? Now, that's not for a moment suggesting that these are not needed, that fundamentally they put you on the right platform, right? But the reality is that the cost of these reforms or the transitions of these reforms, right, has been kind of underestimated by most. So what you gain, somebody tends to lose, and the pain of that loss, I think, tends to drag down things in an overall context. And that's why if you see some of the charts we've put in, whether it is GST revenues, whether it is housing stock being picked up, whether it is IBC, you had a big flux of strong responses to asset resolutions, but now you suddenly got a big pipeline stuck, right? So I think if you really look at it in combination, you actually ended up having a situation where a lot of reform has happened, the transition pain has been high, and so to that extent, at this point in time, they're not bearing the kind of fruit that you would have wanted and hoped and kind of factored in. So that's one point, and it's not necessarily to do only with the reform. But the reality is, given the direction of the economy and these elements coming in together, it has been an overhang. So I think that's one element, right? The other element is, so what do you do about it, right? Do you reverse them? Absolutely not. These are great. These are very positive, and these were needed. I think the reality is that you need these reforms. One, to some extent, they're matured. GST has settled down. The IBC is working. RERA has got established. So all these things, have kind of entrenched themselves. But what you need for them to really play through in a meaningful manner is a general amount of economic momentum, right? And inflation of the economy. And the moment that starts happening, you'll see the benefits of these start to kick through very dramatically. So let's take the case of, say, RERA, right? RERA happened about 2-3 years ago. You've seen housing stock not being sold, housing sales being weak. But if you look at, say, some of the sales you've seen over the last 3 to 4 months, right? And they've been quite impressive, right? The reason that has happened is the fact that you've got the RERA Act in place. People can sit at home and over the internet be comfortable about buying houses, right? Without actually going to the site or only going once, simply because of the protection you have now, which you didn't have previously, right? So I think that the reality is that what you require is a strongish economy, a rebounding economy, right? And a strong market for the benefits of all of this to actually flow through. So, but for that, you need to inflate the economy, because if you don't, right, the lower the economy goes, the harder it gets to leverage on these reforms, right? And then, see, with every reform, there will be a natural set of people who will lose a certain amount of pain that has to be taken. The ability to absorb that pain keeps getting diminished as the economy is weaker.
Okay, so let me try and simplify this from an equity watcher's perspective, right? That let's assume that there is 2 sets of participants, and there are, I mean, I don't need to assume really, but one who can kind of in a way which is more spread out, try and look at the long-term impact of the reform and try and stagger out the buying into those spaces with the hope that maybe in 3 years' time, 5 years' time, 6 years' time, the gains will be made, and they could be enormous, albeit with a bit of a lag. But two, as you said, that in certain reforms, there could be immediate beneficiaries and immediate losers. Now, RERA was done 3 years ago. You're seeing some benefits right now, according to you, and I agree. What about the things that have been done now recently, and what's the potency of those that you think? Because I think Pranab Sen, for example, said that the agri reforms are akin to the 1991 moment. That's a big statement, right? And a lot of people are raving about the labor reforms too. How have you viewed into those two? What's the potency of them? And are there beneficiaries within the listed universe that you guys believe will gain, either in the short term or in the long term?
So again, I think they're important reforms, right? I just think that the response to these will actually tend to be more spread and more expanded, right? And the timeframes will be longer than for the other ones, which have been more regulatory per se, right? Okay. The others are also have a huge element of market practices and businesses tending to evolve and scale being developed. Unlike RERA, where it comes in immediately, or GST, where there's a framework that's changed, or the IBC. So I think the gains can be extensive, but I think the gains will be fought over a longer period of time, and you will keep inching up on them rather than it being dramatic in an immediate sense. So I'd say these reforms are going to be actually longer in terms of their gains for the economy, rather than the bulk of the ones that you've seen so far. So they'll be spread out a little longer. I think in terms of your specific point, in terms of specific companies that will gain, actually so there will potentially be gains, particularly on supply chains for food, for food, and the agri side in particular. But I suspect these gains are more for the average farmer, for the smaller business, rather than necessarily something that will directly find itself into the stock market with big companies or specific companies to play with. So I think it does not have as much of a bearing directly to the stock market as do some of the other reforms that have tended to happen. But the impact could be more broad-based. It impacts a much larger set, right? And a lot of the other reforms have been more concentrated in large businesses and small businesses, whereas these tend to impact much smaller businesses and, most importantly, a lot of farmers. So the benefits are going to be more indirect than necessarily direct for the stock market, I would say.
Okay, and which is fine. I mean, at times those could be very important from a market's perspective too. The other bit is just this very interesting bit wherein you guys have laid out how India has lagged the world in fiscal response. And a lot of proponents of that move argue that one, that we didn't have the balance sheet, and two, maybe when the economy was shut, we didn't need to overstimulate, because otherwise it could have been counterproductive. What's your guess? What's your not guess really, but what's your assessment right now of how we've traversed thus far? And is there something immediately that needs to be done, Aditya? Which, I mean, again, I'm asking this question more from an equity watcher's perspective.
Yeah, no, absolutely. So clearly there is an argument that you don't start putting money into a system that is shut down, right? But that was a long time ago, right? My view is that in many senses, and this is an extension of the reform argument, the fact is that you were slow going into the problem. The slower it gets, or the longer it takes to recover, the greater is going to be the eventual fiscal pain for you, right? So just as there is a feel good in the system at this point in time because Diwali demand seems to be good, or autos seem to be selling, or corporate numbers and corporate commentary is better, if you actually have a little bit more money going into the system, which broadens this, which gives you stuff to be more excited about, the economic response and the tax response, therefore, will tend to be quicker and will actually limit the fiscal challenge that you have over the medium term, right? That's the entire point, that the lower you go, the harder it is to come out, or the slower it is to come out. And I think that's the risk that we are actually tending to run. Do remember, we've been reasonable beneficiaries of a lot of stimulus that has happened globally. I mean, you've seen exports become positive in September, which is a phenomenal element. You've seen a lot of capital come in, but we've been just indirect beneficiaries of a lot of money that's been created globally and a certain amount of demand that has been created globally. But the reality is most of those other economies have bounced better. Their growth destruction has tended to be lower. And we can't depend just on that. We will need to take that chance to stimulate the broader economy in India more dramatically, so that the medium-term pain on the fiscal is actually less, right? The reality is the way to manage the fiscal is to get growth, right? You can't sustainably do it through cost cuts and X, Y, Z. What you require is revenue side momentum through greater economic activity, which then feeds on itself. So my argument is, yes, there are fiscal considerations, but those fiscal considerations could become more dire if the economy from a near-term perspective does not respond, because that's where your fiscal will depend on.
Okay, last couple of questions, Aditya, and this is strictly again purely from what themes, what pockets that you might be looking at, considering all of that's happened. Again, your strategy note suggests that in some fashion, for example, I'm borrowing a chart out of that note, which is a chart number 21, exhibit 21, which says that Bank Nifty should reduce the gap with the Nifty. I wanted to understand from you, how are you looking at banking currently, BFSI currently, considering the fact that a lot has happened for the sector fundamentally, as well as in terms of money chasing. So what's your sense here?
Yeah, so I think firstly, what tends to happen is when you have an issue like you had, right, the financials take the bulk of the pain. And you see this in the US also, where there has been, where the banks have done much, much poorer, and Europe, where they've done much more, much weaker than the rest of the market. So I think there is a natural phenomenon where you're weaker. I think the second thing is, and so we'd actually taken that call also to be negative on the banks. And one of the reasons we said we needed to be negative was we felt that there is a potential socialization of costs, of macro costs that might end up sitting with the banks, right? Now, I think as we've come along over the last 6 months, clearly there will be pain that they will take on the asset quality perspective. Clearly, there will be a lack of comfort or visibility in terms of what the state of asset quality is, right? But I think over the last 6 months, and particularly over the last 1 or 2 months, I think what you're getting is, and this includes some of the efforts that the government has put in through guarantees, through providing much more liquidity to the system, and providing a certain amount of restructuring. So I think where we sit today is that clearly, and you would have seen this with the bank results, that people are talking about restructuring, X, Y, Z, what is the level of NPA and otherwise. But I think where you're sitting today is that I think at the underlying level, I think there is stability in asset quality. I think bank managements have a much clearer picture of what is going to go bad and what is not going to go bad. And so while you still might not get full comfort from the external world, I think there is a certain amount of stability that has happened on the underlying asset quality, which the banks can now see, right? So from our perspective, lack of certainty, large risks underweight the sector, much greater certainty and understanding of what the problem is and the ability to recognize it, start neutraling this sector, which is what we've done. Plus, the bulk of the banking system, particularly the private banks, have got capital to address some of these issues. And the third stage, which we are not calling just yet, the stage when you start getting more optimistic on the banks is when you start seeing lending appetite coming back to the banks. Okay, I think you heard some talk. I think Kotak yesterday talked about the fact that they're looking more aggressively at growth, right? I think the next 3 to 6 months is when you start seeing appetite come back for the banks to start lending. I think that's when the view should start becoming much, much more aggressive. If you want to be early in the game and you think all the problems are recognized, maybe this is the time, right? We just think that, the transition from wanting to lend more to actually starting to lend more sometimes can be a little longer. And that's the phase we are sitting at this point in time. But to take an aggressive call on the banks, you've got to say they're ready to lend. And that doesn't mean just one odd bank, but it's a larger part of the system. That's where the transition happens. But I think now people are not looking at the downside any longer. They've recognized, and that's bank managements, right? Forget the market. Bank managements, I think they know where the problems are. And it's at the next stage when you start putting money out that you will do better. Do remember, the one thing that's changed dramatically for the system is that liquidity is much easier. Funding costs have gone down, right? There are mechanisms in the system, whether it is some of these guarantees, which allow you for a little bit more aggressive lending, right? So if you can make that call that they're ready to put money out, you can be more aggressive. We think it will be a little bit more transitory in its nature.
No, but my only last question, Aditya, to that is that even if you're not taking a call, that let's not try and second guess as to whether the banks will do or no. But let's say in the next, one, that the market tends to look ahead, and this better than me as well, of course. But part two of my question is, if the commentary and the data points and the sentiment itself propels the prices higher before the actual lending does begin, because if Kotak Bank is saying this right now, or HDFC Bank would be saying this right now, and since everybody says that the space for the larger ones to grow is much higher now because they'll be able to dominate, and if they're saying this right now, maybe they'll say this with even more aggression come the period of January when they're assessing the December quarter. So therefore, my simple question is, should one start taking some reasonable bets or too early?
What we have done is, at the end of the day, we've neutralized it, and some banks we have put at an overweight. Somewhere we think there are balance sheet issues, we've still kept at an underweight. So I think you can tweak it within the stocks that you play, either in lending appetite or in capacity from a capital perspective, or in terms of valuations. They have that VIX plus they have that valuation. So I think that's the way. When you go neutral, then you're playing it selectively. You're playing some stocks rather than the average sector at large, right? So I think that's one part. I think the other thing, and that is important to keep in mind at this stage, right, is that you have already had a market response, right, that is well ahead of the economic response.
Sure.
Right? And since you have a situation where the economic response could be a little weaker or might not continue the way you are anticipating, there is that risk that things tend to drop off a little bit. And that's why we spoke last time. I think Diwali is an important point in time to get a sense, and the whole season rather than necessarily the first week that you've seen so far, to get a sense of what's happened to demand, right? What is the end consumer taking? And is it only the malls and the e-commerce guys who are selling? So there's a great celebratory feel about it, but it's compensated by the other parts of the economy which are not being able to buy, right? So I think fundamentally there is a narrowing that's happening, right? But if you get totally excited by only looking at that narrow segment and not looking at the aggregate, that can be a little bit of a problem for the economy. It might not be. It can be good for these few companies that are using this opportunity to get an extra share.
Okay, very quick last question. Do valuations worry you at all? Because you did mention right now, right, that the market response has been ahead of the economic response.
Yeah, so I think valuations are on the higher side, right? Quite clearly in a historical context, but the money in the system is also quite honestly on the higher side, right? Interest rates are on the lower side. So to some extent, I don't think I say, oh, this is just too expensive, and I effectively sell it off. No, I don't think that is the kind of issue. It is just that when you have valuations at a range at a level where the economy has to catch up, right? Then there's always that risk that the under delivery will come on the economic response, which could lower things a little bit. But it's not out of whack. It's not unrealistic to expect a valuation range like this when some other things have changed, and when see, there are other arguments, right? You could actually say that the big thing is that the back of inflation has broken, or the RBI's approach to inflation has changed fundamentally, or there's going to be more money in the system on a sustainable basis, and so the recovery can be more extended than previously. So valuations are on the higher side. The economy has to catch up, where there is the risk that they will underdeliver, but it's not out of whack in terms of the fact that, as I said, rates are lower, there's more money in the system. and you're looking at a cleansed system, a reformed system in many ways that we talked about. A lot of reform has happened, which can actually give you much more acceleration.
Okay. Aditya, it was a pleasure chatting with you today. Thank you so much for taking the time out and speaking to us. So many unspoken things as well, but well, only accounted as much. But happy festivities and look forward to talking to you more often.
Thanks so much. Thanks.
And viewers, thanks for tuning into this edition of The Talking Point.